And what Yellen did as of Friday was she took a very big step towards officially becoming a banana republic style US Treasury.
Saturday, November 4th, 2023, Maneco 64, home of alternative economics and contrarian views. So today I've got two very interesting guests together. We've got Andrei Jakubovizc from Sao Paulo, and we've got Clive Thompson from Geneva in Switzerland, and I'm in London. So it's nice that we can talk from all over the world. And I got to meet Andrei because Clive was posting a lot of his stuff on LinkedIn. So now we're together. Welcome, guys. And it's great to have both of you on the channel.
Hello, Mario.
Pleasure
Hello,
to be
Andre.
here. Yeah. Pleasure to be here.
Yeah, you're welcome. And Andre has gotten up quite early. It's 5:30 in Brazil, and it's 8:30 here in London and 9:30 in Switzerland. So I'll let Clive start with talking about the banks, and in particular Swiss banks. And I know Clive thinks, there isn't anything serious, but there could be. There's a story on Reuters, I think yesterday or the day before, that the Swiss National Bank, the finance ministry, and banks like UBS are talking to try to work out ways to slow down bank transfers because of technology, because apparently that's what led a lot of the Credit Suisse deposits to be withdrawn, and especially from very wealthy clients. So Clive, I'll let you give your 2 cents first, and then Andre can talk about it too.
Well, here in Switzerland, we have about 5 or 6 banks which are regarded as too big to fail. They include UBS and formerly Credit Suisse, which is now part of UBS, Zürcher Kantonalbank, Raiffeisen Group, PostFinance. So those are the main too big to fail banks. And the discussions which are going on with the Swiss National Bank at the moment are what the SNB should do, or what banks should do, in the event we have another crisis such as the one we had with Credit Suisse. Just to refresh your listeners' memories, Credit Suisse, which had had a lot of problems historically, they'd lent money to large companies which couldn't pay back, or where they were losing money. People started to withdraw their money, and it turned into a run on the bank, and money was leaving so fast, people feared for its solvency. So the Swiss government engineered a merger between UBS and Credit Suisse and gave to Credit Suisse a guarantee of 100 billion, I repeat, 100 billion, I think it was Swiss franc, but it might have been dollars, 100 billion Swiss francs guarantee that they would protect UBS in the event of any loss or failure by Credit Suisse, which UBS was effectively forced to buy. Now, on that, UBS, after several months of consolidating Credit Suisse into its books, took a look at that guarantee and said to the Swiss government, thanks very much, but we don't need your guarantee. Now, that wasn't kind of a free, we don't want your guarantee. The Swiss government were charging UBS 200 million Swiss francs a year for the privilege of having that 100 billion guarantee. And simply by giving it up, UBS could increase their profits by 200 million. So it's if they really didn't need it, and they said they didn't need it at all, it's hardly surprising they gave up a guarantee they didn't need. So that was the prelude to what's going on. Now, nobody knows if in the future we'll have a global banking crisis or a Swiss banking crisis or something else. There's no reason to suppose there will be, but it's a possibility. So Switzerland, and I know other regulators are doing the same thing around the world, is the Swiss National Bank is talking with all the major banks about possible moves to rein in any future bank run. And the kinds of things which are being discussed, and it's only discussions at the moment, and those discussions will resume, they say, in the spring, so just a discussion. One is to stagger the withdrawals. In other words, if you suddenly run for your money, you might be told you've got to wait 3 months and then 6 months and so on. It'd be what they call gating. In other words, you have a limit as to how much you could withdraw. They might charge, and again, it's a discussion. The fees, they might charge fees on exit. In other words, if you withdraw your money, you might be charged 0.5% or 1% if you are trying to take out a large amount of money without warning. Or on the more positive side, they're talking about rewarding the clients who tie up their savings. In other words, if you say, I'm willing to leave my money with you for 1 year fixed, they'll pay you a premium rate of interest. And in fact, that is something which is in any case happening. As an example, UBS is paying their customers who lock their money up a rate of 1.75%. To put that in perspective, the 1 year Swiss government bond is paying about 1.65. So they're paying about 10 bips over the Swiss government bond if you'll agree to lock up your money. And other banks are taking the same view. They're offering clients a premium rate if you lock up your money. And obviously, the longer you lock up your money, the more you can get. Now, first of all, I'd like to say there's nothing particularly new in these discussions. It's something which was in existence when I came to Switzerland in 1985. In 1985, I went to UBS to open my account, and they said, what sort of account you want? And I said, well, I don't know. And they said, well, you better have a salary account. There's special conditions. You don't pay any fees. You get an interest rate. Oh, and by the way, you can't withdraw more than, and I can't remember the amount, maybe it was 15,000 or 30,000 or whatever it was. I think these days that accounts, it's 50,000. And I said, okay, that's fine. I don't mind that. I'm never going to draw 15,000 francs in a month. It's not going to happen. So I took that sort of account and paid my salary in monthly and paid my bills from the account and earned my interest until one day I came along to buy a house. And that was about 5 years later in Switzerland. I went to the bank and said, I need to draw a lot of money. And I'd forgotten about this rule to buy a house. And they said, ooh, but you've got the type of account you've got is limited to 15 or 30 or whatever it was, 1,000 francs. And you can't withdraw the 100,000 or whatever I wanted to withdraw to put the deposit on the house. And I said, well, can you ask your boss and what can we do about it? They said, well, what about a mortgage? I said, oh yeah, okay. And I ended up taking my mortgage at UBS, and they let me have the money. And then I came to an agreement with them that, in fact, it was they knew it all along. They just hadn't told me. But the unwritten rule was you could take money out for mortgages, you could take money out for buying houses, you could take money out for paying your taxes. But if you're taking your money out in a hurry to go to another bank, that was where the restriction came in. So that was a very, very old rule. It still exists today for people who have salary accounts. I don't know what the limit is now. I think it's 50,000, but I might be wrong. But there's no restriction on the large balances by the wealth management clients at the moment. And that's what they're talking about bringing in.
Yeah, that's right. And I was reading that as well. They're trying to be careful because if Switzerland and their regulators do something extra to guard against these runs, and other countries don't do, it could be prejudicial to the Swiss banks because clients might move to other countries and other banks. But you, Andre, yesterday, I think, or the day before, you made a comment on LinkedIn saying that SVB was just an appetizer. So with that in mind, maybe you could tell us what you meant by that. And because what happened with Credit Suisse was right around the time of SVB as well.
Well, to Clive's point, I have a positive perspective about what Switzerland is doing right now. I think they're being proactive in order to protect themselves against variables that are beyond their control. And I'll get to SVB in a minute, but what I'm trying to say is, if you look back during the COVID era, you think about Swiss GDP, it's rather small in comparison. But if you think about the Swiss as a prime destination for, saving money, they have by far the best jurisdiction in the world today still. So it's kind of like, it reminds me what happened in Iceland. You have a very good jurisdiction. You have good currency. The least debased currency in the world is and continues to be the Swiss franc. It used to be together with the dollar, but no longer. Now the dollar is being debased at a very fast pace while the Swiss franc is kept his value. that causes a problem because there's a lot of money outside of Switzerland who would like to be protected against debasement. And the Swiss GDP is just not big enough. So the banking system and the balance sheet of both the Swiss National Bank and the banks, those big to fail that Clive mentioned, they're way bigger than Swiss GDP. And that's a problem. I remember, like I said, back in the COVID era, they took a decision to peg the Swiss franc to the euro in a race to the bottom, because then Rolex watches would be extremely expensive. Everything the Swiss manufacturing of high-end products would suffer quite a bit from Swiss franc appreciation, because it's just too small of a pool for such a large pool of money looking for protection within the Swiss franc, within the jurisdiction of Switzerland. So in my view, they learned the hard lesson back in the day, because now they inherited a very large balance sheet at the Swiss National Bank. And those big banks that Clive mentioned, likewise, they have very large balance sheets in comparison with, with the Swiss GDP. With that in mind, what you might understand is they have to try and make some preemptive moves, so not to end up like Iceland. So in my view, these rules that are being discussed, I'm with Clive on that one, because if you start making these preemptive protective rules, you might think, the Swiss are still a very good banking jurisdiction. The Swiss franc is still, the most reliable currency amongst other fiats. It's still an amazing place with the best fiscal numbers around the developed world, but it's a small pool. It's a small economy. So once they start making these preemptive moves, what they're doing basically is saying the fiscal numbers in Switzerland are fine, the currency is fine, but there's a big balance sheet that we inherited from the COVID era, which applies to the Swiss National Bank, applies to UBS and all these other major banks. And it's not their fault, because they have the best jurisdiction, so they attract a lot of money. And what I think they're trying to do is they cannot control what's about to happen in Europe. Different debasement policy, different fiscal solvency, all sorts of issues, geopolitical, detail for the United States. So I think what Switzerland is, the kind of message they're trying to send is to, here we're going to make some preemptive protective measures where you will still be here in a market-friendly jurisdiction. We have no intention in debasing the franc, but due to what's going on around the world, and here in Switzerland being, a very desired destination for people to hold their money, if there's an event beyond our control, we want to be able to survive it by, if need be, enacting certain measures to avoid a panic and a big disruption of our banking system. And if you stop and think about it, correct me if I'm wrong, but banking is by far Switzerland's most large industry. So, I mean, if the Swiss banking industry goes down, I mean, so goes Switzerland. So I think what they're doing, basically, you might think as a positive, because they are being proactive in telling people, look, if we all abide to these certain rules, so to avoid panic, if need be, we create some gates, we'll weather the storm fine. But if we let people run off with their emotions based on stuff that is going around the globe, and here there's a big item here called counterparty risk. These banks, they're all intertwined. Derivatives, credit, overnight borrowings, it's so connected. So I'd like to think that if you take a picture of the Swiss banking industry, including the balance sheet of the SNB, it looks a lot like everyone else's. You have, you have duration losses in connection with sovereign bonds. And I mentioned yesterday to Clive, if you look at Europe as a whole, including Switzerland, I think they are by far the more exposed because you had like maybe a decade of $1 trillion negative yielding sovereign bonds. And now you have these high positive rates. I mean, I would guess that the losses in duration losses in Europe are quite large. But then again, if they can act in coordination, they can protect these losses from becoming real losses by allowing these banks to hold it to maturity and maybe borrow against them. It's probably going on already, a BTFP of sorts in Europe. So that would solve the exposure to sovereign bonds, long duration sovereign bonds. Then you have, your private portfolio. You have like CLOs, you have mortgage bonds, all sorts of risk assets that those banks in Switzerland also have. They have interbank exposure with each other. And this is going to be a problem on a global scale. And I think, look, I'm drawing a parallel between two pools. One is duration risk from sovereign bonds. And they plug this already. They will probably be renewing the BTFP as long as they need to do it. But there's another shoe to drop, which we've seen anecdotal evidence that has to do with private credit. CRE, we hear a lot about CRE in the US. We hear about car loans, student loans, all sorts of indications that there's about to have stress in these assets.
CRE, commercial real estate, for those who don't know what it is.
Yes,
that's right.
So I think, when I stop and think about it, the debasement going on with the Swiss franc is not relevant, is a lot better than everybody else. The fiscal numbers in Switzerland are quite honest in comparison with the madness out there. So I guess what the Swiss have to do, because they have this large balance sheet, much larger than the economy, is try to create these preemptive measures that might or might not need to be implemented. Like Clive said, we don't know what's out there. I'm not going to kid myself to thinking that, Swiss banks are in better shape than everybody else because they're all in the same boat. They have all the same exposures. So I think Swiss is being preemptive in terms of letting their depositors know that they will be less exposed to some kind of panic in case it comes up. What could happen, Mario, is you might have a panic in the US that will spread all over the place. And I think that's against that kind of variable that the Swiss don't control, that they're trying to make some preemptive measures to avoid this big contagion.
With rising inflation, bank failures, and massive layoffs across multiple sectors, the future of the economy remains uncertain. It's no wonder the central banks have been getting prepared by stockpiling gold. At ITM Trading, we have spent over 27 years building a team of seasoned researchers and analysts who can help you prepare for any financial crisis. Our experts are ready to provide you with proven strategies to safeguard your wealth and assets in the event of an economic downturn or currency reset, which is frankly inevitable. Don't wait until it's too late. Schedule your free gold and silver strategy call by clicking on the link in the description below.
The article on Reuters about this even mentioned regulators in the UK with the Bank of England. They're working on things. Everyone's worried really that with the internet and online banking, it's much easier to just take your money out, and send it to another bank. And maybe that's why they're working on a CBDC to lock everyone in to the banking system, because if you can't take cash out, then the banks are going to be relatively safe. And you talked about duration risk, and for those viewers who don't know, it's to do with long-term bonds, how the price fluctuates. When yields go up, they drop a lot more. And you mentioned, I think there was 17 trillion of European government sovereign debt that was negative yielding. That was back in 2017 or 18. It was a huge amount. And now I think there must be very little of those. And there was this Austrian 100-year bond. There's none. Yeah, there's a Austrian 100-year bond that I think was issued in 2020 or 21, and that the price of that is now like in the 30s. I mean, Clive, maybe you could talk a little bit about the bonds, especially because this past week was very good for bonds, but I still think we're not out of the woods.
A few years ago, I wrote about the madness. This wasn't on LinkedIn at the time, but I wrote about the madness of the Austrian, and I think there's an Irish bond as well, which were trading at several 100%, like 280% of parity because of their very long duration. And I said, what is the madness of people buying these bonds at, let's say, 280% when they know they're going to redeem at 100, albeit in 80 years' time? It made no sense. But what happens in the bond market, for your readers who don't completely are not familiar with it? A bond has a fixed interest rate and a maturity date. So let's say a bond is yielding 2%. Now, if interest rates start to rise and the yield on that bond goes to 3%, it basically means the price of the bond has fallen to such an extent that that fixed coupon of 2% on the new price is equivalent to earning 3% on the new price. So while in the financial world, we all talk about yields and yields going up or yields going down, and right now they're going up. So when we talk about yields going up, we're talking about the bond prices going down. And this is a problem for the banks who own bonds. It's a problem for the pension funds which own the bonds. And it's a problem for anybody who owns bonds because their assets are going down. And the problem we're talking about in the banking sector of falling bond prices is this. Banks typically borrow from their customers in the short term, in other words, overnight deposits, and they lend to the investors on mortgages, and they lend to the government on the long term. So they have long-term assets with fixed interest rates often, and they have short-term liabilities. And that's fine as long as everybody doesn't come to the bank on the same day asking for their money. And that generally didn't happen very much in the past, except in very serious situations. But things have all changed. In the modern world, the biggest enemy of the bank is not the queue of depositors outside their front door trying to take the money out. The biggest enemy is your mouse. And the reason it's your mouse is because a rumor can spread at the speed of light. A fact can spread at the speed of light, and you can withdraw your money at the speed of light. So we saw that with the SVB bank when in America, when somebody started a rumor, and Andre knows all about this, but started a rumor. Well, it wasn't a rumor. It was just he rang up a lot of people, or actually did a tweet, I think it was, and said, I think you should take your money out. And everybody who was anybody said, well, might be true, might not be true, but I'm not going to be the last one to get my money out. So they rushed to take their money out, clicking the mouse, and literally billions started to leave per day at a very, very high speed, faster than we'd ever seen in any bank run in history. And
Clive,
that caused a failure.
It was 70 billion in 48 hours.
And I think the next day it would have been 100 billion if they hadn't stopped it.
Yeah, wasn't that Peter Thiel or something?
Yeah, exactly. It was.
Yeah.
It was him.
And the thing is, I think they realized, or Peter Thiel or someone, that these banks are sitting on huge, even though they're held to maturity, they're huge losses. And they're saying, wow, they looked, apparently I read something that the people never looked at these things, but because it was always in the footnote. But now everyone's looking at the huge held to maturity losses that the FDIC publishes every quarter. But what about this week, Clive? We've seen like the 10-year yield drop from almost 5 to 4.5. Give your view on that, and then Andre, do you think everything's fine now and we're out of the woods and yields are going to go back to 1 or 2?
Well, for once, Janet Yellen has pulled a rabbit out of the hat, which is kind of amazing, because I wasn't expecting that much genius from her. But what they basically said is that they are not going to be tapping the long end of the market, the 10-year bond, for example, or the 30-year bond or the 20-year bond for the time being, and they're going to borrow at the short end. Now, the reason they're doing that is because the yield on the 10-year bond was approaching 5%, and I think everybody on the planet knows that's a real problem. And so to try and starve the long end of new issuance by the Treasury, they started to borrow at the short end, at the 1-2 year end. Obviously, that's pushing up interest rates on the short end and pushing. But what happens is, because the long end doesn't have this new issuance of 10-year bonds, the price of the 10-year bonds has risen and the yield has gone down to something like 4.5%. This is merely shoving the problem around. But I think what the genius bit is, it's created a psychological situation for investors, many of whom are thinking, well, I should have grabbed that 5% when it was available, and I didn't. And now all I can get is 4.5%. So if I ever see the rates approaching 5% on the 10-year bond, I'm going to grab it. So what this has done has created an army of pension funds and other investors who are all getting ready to buy the 10-year bond if it gets back to 5% yields, which is actually what the Treasury needs, because the Treasury needs to borrow a lot of money. It needs to borrow several trillion a year, 2 trillion a year, to fund its overspending. So that's 2 trillion a year over and above the 5 trillion, whatever it is, that's redeeming from existing investments. So let's call it 7 trillion plus another trillion from the Federal Reserve quantitative tightening. So, but the reality is new issuance is net is going to be about 2 trillion a year. So they need to borrow from somewhere. They either have to borrow for the short term, 1 year, 2 years, or for the long term, 10 years, 20 years, 30 years. But what as they need to borrow this, they've just created, through this rabbit out of the hat, a sort of demand at the 10-year end, where a lot of people are now going to, when they next come to tap the market, and I don't know when that'll be, but it might be a few months from now, a lot of people are going to be saying, I won't miss it the second time, and they'll be buying when perhaps if rates were where they were, they wouldn't have bought. Now, I think that in the long run, the 10-year yield will still go higher. That means the bond price will go lower, and I think we'll see yields over time above 5%. And the reason for that is very, very simple. The US government has this 2 trillion a year borrowing requirement. That's something which is going to go up. The interest payments on their debt are nearly 1 trillion already. I think maybe it's 750 billion or something, but it's obviously with the rates going up, it's approaching 1 trillion very, very rapidly. And though that means the amount they're going to have to borrow based on their current budget, if they don't change it, and if they don't cut spending or raise taxes, it means they're going to have to borrow more and more. And the only way you can borrow more is if you offer your investors higher yields to tempt them in. So I do think that this rise in long-term rates has not ended. I think it's going to carry on for quite a while.
So, Andre, what's your view on that?
I'd like to share a screenshot here real quick. I'm not sure if I'm good at this, but just for fun. Can you guys, did you guys see it?
Yeah, we can
see it.
Yeah.
I see a lovely Ben.
I wish you wouldn't let me do this again, Mario. I'm too dangerous. But anyways, look, what happened on Friday was remarkable. And if I may say, the entire global financial system resides in the US bond market. And there's no way on earth you can see this kind of volatility in the 10-year bond, in the 30-year bond, in the 20-year bond. That is a crystal clear sign of something that is under stress. Okay, that's the first remark. The second remark is, as of recently, markets were very spooked because of the number, the sheer volume of debt issuance that the Treasury announced. They're running a $2 trillion annual fiscal deficit and rising fast. So what we saw before Friday was markets very skeptical about the long end. They thought of the US being in fiscal dominance. The debt is not sustainable, as Clive just mentioned. So the common sense will lead you to believe that the Fed is about or was already losing control over the long end. And that would spook everyone. So what did she do? What did Yellen do? And it's quite interesting because as the Fed raises rates, you have a lot more debt servicing costs. That's liquidity being paid to bondholders to the tune of $1 trillion a year. You add $2 trillion in fiscal deficit, you're injecting $3 trillion in liquidity into a system that is still humming along in spite of the Fed rate hikes. So the more they spend, the more they enhance the fiscal deficit, the more the Fed needs to raise rates, the more they issue bonds, the more debt servicing costs are injected in the economy. And make no mistake, we're in a doom loop. There's this kind of tug of war between the White House. They don't want a recession. They have an election coming up. So the game plan is simple. If Jerome Powell is to keep raising rates and sucking up money from the real economy, we're going to make up for it by expanding our fiscal deficit, hence increasing debt servicing costs. And what Yellen did as of Friday was she took a very big step towards officially becoming a banana republic style US Treasury. So bear with me for a second. You have $1 trillion still sitting in reverse repos. You have, the wealthy are holding these bonds and they're starting to get a ton of money in debt servicing costs. And what Yellen did to promote what she did on Friday at the expense of the US dollar, she said to the market, look, I'm going to issue a lot of bonds, but then I'm not going to stress the long end. I'm going to issue short-term T-bills like Brazil used to do back in the high inflation years. And if anything, the money available to buy these attractive T-bills is sitting there in the reverse repo market and other short-term pockets. So there's a lot of liquidity in the system. It's quite a bit of liquidity. It's not only in the reverse repo market, but as long as they keep accumulating $1 trillion plus in debt servicing costs, they will be able to buy these bills without harming liquidity in the system. So Yellen found a way, a short-term fix, where she can issue all the bonds she needs to keep enhancing the fiscal deficit, except that she's funding it very short-term. She's keeping, so the reason why the 10-year went from 5 to 450 is because the market woke up to the fact that at least within the next 3 to 4 months, there won't be any long end issuance. And they decided to feel better about, excessive supply of bonds in the long end. So what the market is seeing is, well, there's a lot of liquidity coming in from the fiscal deficit. There's a lot of liquidity coming in from debt servicing costs. And those issues that Yellen is going to do are short-term, and the money is sitting there to buy it. So they thought to themselves, well, there's not going to be a liquidity squeeze. We can keep humming along with equities and so on and so forth. And if you add to this mix that Japan launched a an inflation package, an anti-inflation package by printing 100 billion. If you think about the Chinese are doing the same thing, global liquidity is acting as if, as if we were in the early days of COVID of sorts. And it is what it is.
And I put a chart here of M1, which is like, the money supply, which is deposits, cash, and cash. And it has dropped quite a bit, but it's still above the high from May 2020, which was the height of COVID. And if you go back pre-COVID, we're so much higher. So there's still, like you said, a lot of liquidity. The other thing I would say about this, I think this was a de facto yield curve control by Yellen. They didn't announce it, but it was, yield curve control. The risk here, because there's always a risk to everything, there's no such thing as a free lunch. So let's say in a year or two, for some reason, interest rates start rising again and they go to 7 or 8, the Fed has to raise them. The Treasury is going to have even more problem because all this extra issuances doing on the short end, that's going to mature. So, and if they were still issuing 10 years now at 5 or even 4.75, they could wait another 10 years to refinance that. So maybe I'll let Clive jump onto that and respond to what I.
Well, yeah, issuing all this debt short term is. It's going to mature in the short term. It's got to be refreshed. And the question is, at what interest rate are they going to renew it? So I think what they're doing is incurring extra expense in the future in order to keep expenses down in the short term. Problematically, they're pushing the problem on to the next administration in the United States. The next administration is going to have to deal with a lot of maturing debt, which it will have to refinance because it's going to mature in the short term. And therefore, they'll not only have the previously issued long-term debt maturing, but they'll have the newly issued short-term debt maturing, creating a sort of hump in the amount of money they need to raise for the next administration in a year or two's time. And that's going to be a problem because the market probably won't be able to absorb very much of it. So that will mean, in my opinion, higher long-term interest rates and quite possibly higher short-term interest rates. But of course, we have to remember the short-term interest rates are very much under the control of the Federal Reserve. Now, I'd like to just say one thing, that might not happen because the Federal Reserve is sitting there and the Federal Reserve can at any time step in. And they haven't stepped in at the moment because they've got this quantitative tightening going on. But at any time, they might decide the situation has become so dire that they need to do something. Now, if the Federal Reserve steps in, what will they do? They will be, first of all, lending a lot of money to the government. Short term, the government will issue them with bonds and they will print the money and give it to the government, which spends it. Or they will be going into the market and buying up longer dated bonds, the 10-year bonds, to keep the yield from going above a certain level. And that again means that they'll be printing the money to buy those bonds. And when they print the money, that money goes into the economy. And at the end of the day, it inflates the value of asset prices and to some extent, retail prices or consumer prices as well. And so all debt that is issued by the government is nothing other than a future promise to print money. So as we noted, the levels of debt in the United States, they're well past 100% of GDP. That's way too high. The Maastricht Treaty in Europe thought that anything above 60 would be a problem. Again, it's not America, but certainly 100% is way too high as a level of debt. So what they've got, and that's increasing by several trillion a year. So that's about 2% of GDP a year. So at the end of the day, we have this promise to print money in the future, which at some point will spiral out of control. And there's no telling what would cause that to spiral out of control. There could be an incident, a crisis, a situation. It might be a terrorist attack, it might be a climatic event, it might be a banking crisis, it might be a recession, it might just be a political crisis. Who knows? But you get this, you get to a point where there's a crisis and people suddenly distrust the currency, and the internet is alive with people saying, get out, get out, get out. Everybody's rushing for real assets. The shops start to empty, and then they bring in controls of what you can do with your money.
Yeah,
Mario.
Oh, want to say one thing as well, that the genius Yellen managed to do is to invert the the yield curve was going towards 0 to tens, which signals a recession. But with the move now in the 10-year, that it's inverted again, and I think it's another good thing for them, that they can say, "Oh, look, the markets are saying there's not going to be a recession." Just wanted to put that out there. Sorry, Andre, go ahead.
No, to your point on what she did to the long end, she already announced that as of January they're going to enact certain yield control curve operations. What I think she's going to do is a lot more than what she already did. She's going to provide liquidity for the so-called off-the-run bonds. Maybe Clive can explain your viewers later on. And she's going to expand the short-term issuance of T-bills and hope that there's money in the reverse repo market, there's money from the fiscal deficit, and there's money from debt servicing costs to push this, most she can until, until there's pressure on the long end of the yield curve once again. I'd like to say on Clive's comment, Clive, what you said is the very exact reason why Jamie Dimon came out in public and said, be prepared to 7% Fed funds. Because what Yellen is doing by financing US debt short-term, taking advantage of what's imbalancing the reverse repo facility, taking advantage of these very large fiscal deficits that are increasingly more likely not to be paid, at least not without printing money. These very large debt servicing costs, which is, they keep rising. So what the Fed might be forced to do is to keep raising the Fed funds rate. And if you stop and think about that, I don't know how long this can be sustainable, because once you have Fed funds at 7, the debt servicing costs go through the roof. And basically, all those monies from debt servicing costs, all those monies from the fiscal deficit are going to be required to absorb, the short-term T-bills that are going to be issued. And there's not going to be any money for the real economy.
I'm smiling, Andre, because you're talking about 7%. I actually, I'm on the same page as you with that. I think we are going higher. But what makes me smile is when I look at the Congressional Budget Office's budget for the next decade. Over the next decade, including the current year, next year, they have an average interest rate. They are assuming they're going to pay on their debt of 2.8%. Now, I don't think they're going to be paying 2.8% this year, next year, or any time in the next decade. But that's what they're assuming for the purpose of budgeting.
One thing I believe Mario's viewers should understand is that they're telling it like it is. Yellen thinks that that doesn't matter because she thinks if the US Treasury can manage, or the Fed can manage, negative rates of interest on real terms, by debasing your money, hopefully slowly but surely, without many ups and downs, they can entice savers to hold on to T-bills, say, earning 4%. You might have an official rate of inflation of 2, which is in fact 10 or 12. And they can inflate this throughout the next 10 to 20 years. So it's becoming increasingly less possible to hide what they've been doing for decades on end, because now we have people like you, Mario, like Clive, who can tell it like it is, as opposed to, what you watch on CNBC. So she came out openly saying that she can issue debt for as much as she wants, as long as it can be inflated. Hopefully, in a serene way, like, I'm going to take away 4% of your purchasing power every year. You're going to have to accept it, because if not, we're going to corral you. We're going to gate you. We're going to create captive demand for these bonds. You're going to be debased slowly, but you will. And one thing that helped price action on Friday as well, which I think doesn't make any sense, Mario, is oil is going down. So I think this thing was somewhat orchestrated. I'm going to say things from, my trading days. It's clear to me that they are knocking off on the VIX. So the VIX went down to under 15, and the stock market did not go up proportionately. For the VIX index, which is a measure of volatility, to go down so hard, I'd say the S&P would have to have gone a lot higher. So there's, some price suppression on the VIX, and there's a lot of price suppression in oil as well, which is the bellwether for inflation. So all of a sudden, the market is saying the VIX going down, oil taking a dive, the dollar taking a dive, a huge dive, and all these monies coming in from China, from Japan, the short end. So the long end of the yield curve no longer spooking everybody. And these markets just took off. They just took off. So I think
they also kept gold from rising above
absolutely
1,000. You could see it every time it got to just over 2,000. It came off, and you would think from yields going from almost 5 to 4.5 in a matter of a week, that the negative that drop would help gold. But I still believe that, from what you guys are telling me about this debasement, that over a decade, there's only very few places to hide financially, and I think gold and silver are going to be one of them, and real assets. Maybe Andre can tell us his view on how to protect not just people who have a lot of wealth, but maybe, people in between, or even young people who are beginning. So we'll start with Andre, and then we'll finish with Clive.
To your point, I have a very interesting theory about, gold going forward, because this price suppression cannot go on forever without consequences. And now we have to go into the geopolitical aspect of what's going on in the world. I believe that outside everything that is debatable, there's one thing that oil producing countries and hard asset producing countries, regardless of the fact that Russia has been kicked out of SWIFT and all sorts of weaponization of the US dollar. I mean, you look at the likes of India, and they might think, we don't know, we want to go all in with the BRICS Plus because we are under the influence of the US. We still need them to keep a relationship with them. And the US doesn't like it when you want to trade with everyone. The US is kind of like, either you're with me or you're against me. And that's the problem. The US became a problem. Why am I saying that? Because there's one thing within this whole geopolitical mess that is certain. Hard assets being sold for worthless currency became real, became a sure thing. So you have to find a solution for that. And what's in the cards starting in January, BRICS Plus have a mechanism where price discovery, in my view, is going to China. You know, if you think about the physical gold exchange in Shanghai, which allows people to trade commodities for retrievable gold in China, there's $100 gold premium between China and the Western world. That's not normal. And that has been the case for quite some time. What I'm trying to say, Mario, is also Iran and Iraq, they're starting to back their own currencies with gold so they can have a two-way street between gold being sold to China, oil being sold to China in exchange for yuan, gold-backed yuan. Said gold, you can retrieve it eventually. So the gold is moving from west to east. This is going to make the West very uncomfortable and very more difficult for them to suppress gold price. And the point is, you suppress the price of gold now, all you're doing, you're making time, but all you're doing is you're allowing China and Chinese citizens to buy gold, physical gold, on their cheap. But once this oil for gold and commodities for gold amongst the BRICS plus, once it becomes, once the network effect of this arrangement starts to grow, you're going to have a big challenger against the paper gold market in setting gold prices. So what I'm trying to say is, this gold is going to Asia, is going to remain there as a backup for the BRICS plus trading in hard commodities. And if you stop and think about Europe, I have this theory that because Europe has zero hard assets and they need food and energy, I would not disregard the possibility that out of necessity, Europe might have to revalue its collective gold reserves, if not to have a currency that can be used to buy hard assets, mainly food and energy. Because what is the euro going to be worth under current conditions? You know, the fiscal situation in Europe is very bad. I would like to suggest to Clive, you mentioned 17 trillion sovereign assets, negative yielding. You can model the size of the hidden losses in European banks. If you fast forward to today, look at the prices for these bonds. I think they're sitting on a ton of losses. And by the way, they have no hard assets. So they have a potentially worthless currency, and they still need to buy hard assets just to keep the lights on. So eventually, as the BRICS plus gold-backed trade expands, the bullion banks are going to have a much harder time keeping up with price suppression. And I think Europe, not the United States, because they have hard assets, but Europe might be forced into a very tough situation. Maybe they might create, Mario, a specific gold-backed euro for trade and keep the populace with fiat. I don't know. I'm just throwing stuff out there. But I do believe that price discovery in gold might happen much faster because, the BRICS Plus is about to launch in a couple of months. And we're going to start seeing things a lot more visible than what we've seen so far. The most noticeable is the premium, gold premium between East and West. It keeps up. China bought a record amount of gold recently. All the BRICS bought a record amount of gold recently. And they keep suppressing the price. But by doing so, gold is going east. And it's enabling them to have a big stack of gold to back up this new trading arrangement where, selling oil for worthless currencies is not an option. I'm not going to go into the geopolitical weaponizations, but if you stop and think about the real value of these fiat currencies, why would Saudi Arabia continue to accumulate worthless dollars?
Especially when Yellen wants to devalue it by 4% a year.
So I certainly second what Andre is saying. I think there are many, many reasons why hard assets, that includes gold, silver, and equities, and Bitcoin, actually, though one could argue whether it's hard or not. But I think there's a lot of reasons to think that these types of assets will rise in price because of the expansion of the money supply over the certainly the years to come. And I would therefore minimize my exposure to bonds, minimize my exposure to cash. And perhaps I know you're on a time scale, Mario, so I'll finish off a little bit quickly here. Just reverting a little bit back to the comment about Switzerland.
I've got time, Clive. It's not
okay. So yeah, just on Switzerland, which I wanted to put it in a bit earlier. The main industries in Switzerland are, of course, as Andre said, it's the financial industry. Switzerland is well known as one of the premier places for managing finance. And I can say that I'm an ex-private banker, but I've got no loyalty to any bank or any, I'm not working in the industry anymore, so I can say it freely. But what I can tell you is if I was to leave Switzerland, go and live somewhere else, there's absolutely no doubt at all in my mind I would keep my wealth management in the Swiss banking system for the reasons we've got a rule of law, you've got excellent banking. I know it's you could do things in Swiss banks, and I mean legal things, which are way beyond what you could do in most countries. Now, England is a pretty sophisticated place for doing banking, but Switzerland literally surpasses them all. So I definitely keep my wealth in Switzerland if I had to move abroad. Other industries in Switzerland, of course, the finance industry, that does include trusts, legal, family offices, and of course the banking. But tourism, chocolate, watches, food with Nestle, of course, and very importantly, machine tools.
Jeez.
Companies all around the world buy machine tools and precision equipment from Switzerland at way over the price they could have bought it somewhere else, because they know they're going to get something which works and which is not going to break down. And if you've got a factory and you have to buy a certain type of valve, you need it to keep working and not break down, because if it breaks down, it's going to cost you millions. So rather pay over the odds to get a really, really good one from Switzerland, from one of the Swiss precision industries, than go to another country where you're not sure that the quality is going to be there. So Switzerland, and that's one of the reasons Switzerland has survived so well. It can't sell cheap goods like China. It's impossible. The salaries are the highest in the world in Switzerland. The Swiss franc's the highest currency in the world, the strongest currency in the world. It can only survive by selling quality. That's the only thing we can sell.
And you've got tourism as well, I guess.
Tourism, luxury goods, watches. Well, cheese, yes. And
cheese
wine,
is my favorite. That's why I keep saying cheese. It's my favorite.
Yes, indeed.
And Clive, so I assume you're with this. I think they called it in the 50s. They did the same thing, but people didn't twig onto it. Keeping rates below the rate of inflation. It was called financial repression. And that's what not just Yellen is trying to do. Here in England, they're doing the same thing, because we have, the rate of inflation really near 10% or even more, and we're only getting like 5% interest. So I guess you remain also. Well, both of you guys think hard assets are going to be the place to be, right? But
if you have cash in the bank earning interest, you are going backwards in buying power. That's a fact.
Yeah. And I think a lot of people are going to be fooled. They're going to tinker. They tinkered already with the CPI last year here in the UK. And I noticed it because I used to look at the Bank of England inflation calculator, still do. And prior to that, if you went back, let's say to 1914 to present, the average inflation was like 5 or 5.5, and now all of a sudden it's dropped to like 4. So they're definitely gonna keep tinkering the numbers, and but hopefully people are waking up to it. So to wrap up, just wanted to ask first Andre to what he thinks is the most important thing for people to focus on financially, but also maybe overall, you know, like psychologically and mentally in these confusing and like deceptive times, because I think what Yellen is doing is deceptive. And then Clive.
Well, to your point, holding hard assets at this time of uncertainties is a good advice. If you stop and think about gold, gold has performed really well. I think I shared with you, Mario, on your message board on LinkedIn, a piece from I think it was from Fidelity's global macro head, chief economist. And if you look at gold on a risk-adjusted basis, is the least volatile and the best return. So what people must understand is if you want to hold gold, you must do it for the long run.
Can you explain to people what this means, the Sharpe ratio? Because a lot of people have no idea what this is. So,
well, what I mean is more volatility, more price swings, the more the risk. So if you have an asset that has relatively lower price swings, meaning lower volatility, but they can still deliver a competitive return, that's what you call a Sharpe ratio. Its Sharpe ratio measures your return on a risk-adjusted basis. So from what you're displaying, it tells you that gold has very good return with, a very good Sharpe ratio, low volatility and still very good returns. So a lot of people might become frustrated when they do paper gold markets to suppress the price. But as you do this for decades on end, you keep gold prices artificially low and allow people to hoard it. And if you have patience, you're going to fast forward to today, Mario. And for the first time in history, we've seen the largest and fastest move in interest rates ever. You went from 0 to 5 in no time. And when you stop thinking about going from 0 rates to 5%, 5.5% at record time, look, this is not back when Volcker was at the helm, when debt to GDP was 30%. We're talking about 120% debt to GDP. So 5%, 5.5% Fed funds rate over 120% debt to GDP is pretty much equivalent to what Volcker did back in the day. But here's the catch. With those furious and high interest rates on such a high leveraged economy, gold should tank. And it's not happening.
yeah,
Gold is, flirting with 2000. They try to keep it from breaking out. And by doing so, they're just buying time because now people caught up to the first layer of, hey, what's going on here? Rates are going higher and gold is not budging.
so
Something to do.
Sharpe ratio here, the closer, when it's at 1, does that mean that it's like cash? Is it really safe? And what does it mean? Like it says Bitcoin is 0.45. Does that mean Bitcoin is twice as risky?
A lot, exactly. Twice as volatile with, the returns on Bitcoin are higher, but it's a lot more volatile than gold, twice as much.
It's interesting that the USD or US dollar is even more volatile than Bitcoin. It's like 0.3.
Oh, you just look at the DXY. It goes all over the place.
Yeah.
So yeah, it is volatile.
Yeah.
I wanted to add that, people caught up to this first signal where gold prices are holding up, where in fact, they shouldn't. If you look at history, every time rates go up, gold tanks. It's not happening. And by doing so, they're buying time because they keep suppressing the price, but that is allowing Chinese people, Chinese central banks and the BRICS Plus to hoard ever more gold, avoiding US Treasuries. And once this BRICS Plus arrangement starts escalating, volumes of trade backed by gold start escalating because accepting useless fiat is not a long-term option. I mean, you could buy stuff for dollars now, but how long? How long until, you're gonna keep something that keeps being the base? So now, as soon as my view is, once this BRICS Plus starts escalating, we could see gold prices going crazy real soon. You see, Mario, you think of the paper gold market in the US. I think they are like the open interest in the paper gold market might be 200 times bigger than physical gold. Once this physical gold keeps pouring in to China, there's $100 premium there. This thing that is already 200 to 1 might go to 1,000 to 1. For how long they can keep up suppressing the price, especially when there's a lot of trading on hard commodities backed by currencies linked to gold. Yeah. You understand my point? And here's the thing. The larger the trade volumes, the more demand for gold to keep this ecosystem growing. So the gold is going to, if they keep on doing that, if they keep on down this path, eventually all of the gold in the planet is going to end up in Shanghai. I'm putting it very simply, but I expect something to happen big time, especially next year when the BRICS Plus start going full-fledged.
Andre, they're not going to get my gold. That's my quarter ounce American coin.
Yeah. So Clive, maybe you could wrap things up and with some words of wisdom.
Well, first of all, it's only a question of time before something pops in terms of the money system we're in today. So I'd encourage everybody to have a few silver and gold coins at home, because when the brown stuff hits the fan, I was going to say a word I should have said there. When the brown stuff hits the fan, you're going to have to bail out your family, your friends, your neighbors. So make sure you've got enough for everybody you know to go around. Because if we go back to the situations which have happened all over the world where the money has gone to nothing, at those times, gold and silver kept its buying power, and the local farmers, they wouldn't take your fiat currency when it was going down the drain. They would say, I want silver or I want gold. So that's what you've got to have at home to some extent, but don't keep too much, because otherwise the risk of robbery goes up. So you have to put the rest in a very safe place where you can access it quickly and easily. That would be my message to people. And in terms of following my views and Andre's views, I know we're both on LinkedIn. We both write. That's how we connected. But we write articles about the financial system, and anyone who wants to follow us can do so free of charge, and therefore read all of our articles when we publish them.
Great. And thank you guys very much for coming on and sharing your time with me. And I wish you all a great weekend.
Likewise. Thank you, Mario.
Well,
thank you very much, Mario, and have a lovely afternoon.
Thank you.